The VIX is dead. Yes, the VIX is dead indeed. We've got a lot to get into in this video here today, folks. We've got to talk about what the VIX being dead means for the stock market over this next 6 to 12 months. We've got to talk about a lot of stocks in today's video, a lot of other random things. Action-packed video. I appreciate you all joining me as always. Thanks so much for being here. Thanks for smashing that thumbs up button. Thanks for being subscribed, all that good stuff. Okay, so just want to jump straight into this one. This is the VIX index, and basically what I'm showing you here is the past 30 years or so in regards to the VIX, okay? And the VIX is just kind of a measure of how crazy the stock market is at a particular time or not crazy. And, you know, usually if you're in a major sell-off, a major market crash, some sort of scenario like that, the VIX is going to spike extremely high. This happened in the tech bubble. This happened in the great financial crisis. This happened, obviously, in the Rona crash. The VIX spikes huge. Right now, in time periods that you're going through where the market's very calm, everything is kind of smooth sailing, the VIX goes lower and lower and lower, and no one even really pays attention to the VIX in those particular times. It's really only the time periods where people are really scared, fearful, is when everybody's paying attention to the VIX. So what I'm showing you here, like I said, it's about the past 30 years or so. If you're below the blue line, the VIX is dead. That's where we're at right now. We're at a 12. And so anything below a 15, you're at a dead VIX. It's donezo. If you're in kind of the 15 to 20 range, you're in a dying VIX area where the VIX is slowly facing death. If you're in a 20 to 25 range, that means you're starting to get an elevated VIX. It's coming to life. And if you go over a 25, that means the VIX is starting to get pretty out of control, and there's likely something going on that's causing major fear in the stock market overall. So right now the VIX is dead. It looks like it's continuing to die, and if this market remains, let's call it nothing crazy happens here, the VIX is going to be more dead and more dead. Next thing you know, you're going to see a VIX with a 10 in front of it. This is a 5-year chart here. Now, what I want you to pay attention to is look at exactly where we were on the VIX prior to Rona, prior to the Rona crash and that craziness that happened. Check this out. We're back to the same levels we were right prior to Rona now at this point in time, okay? So that's actually kind of more of a normal territory when you're kind of in that, 12-ish range, 14, 15, anything in there, you're in a normalish range, right? We went through crazy VIX for quite a while. We obviously went through the Rona crash crazy VIX, right? But then last year we went through some very high cycles of VIX as well. And the reason being is the Fed was raising rates at the fastest clip we've ever seen them raise rates at in the history of the Federal Reserve, and we hadn't been used to that. Like, when's the last time we really saw high inflation where the Fed had to keep raising rates at such an aggressive manner? Last time was the 1970s into the early 80s. So it had been so many decades since we saw something like that, and it caused obviously massive amounts of fear. Everybody was predicting recession, all these sorts of things, when all along it usually takes anywhere from 12 to 36 months before the Fed lags end up starting to catch up with the economy. So, everybody was just way too, making their predictions a little way too early in that sort of situation. So, that's where we're at right now. Now, there's 3 ways this VIX can spike back up in 2024. 3 ways, and there's only 3 ways I can see it happening. One is a recession actually hits. Not like talk of a recession. Oh, I think there's a recession coming. Everybody's so sick of hearing about recession possibilities. They've been hearing about it for 2 years now. Everybody's done in regards to that. You need to actually have it. You need to actually have unemployment spiking up in a massive way, something like that. If you had some sort of scenario like that, which I don't think is the highest probability, it is a possibility in 2024, but it's actually not the highest probability in 2024. If you have that, the VIX will spike up again, huge, and next thing you know, you'll see a VIX with the 20 in front of it, and next thing you know, you'll see a VIX with a 30 in front of it. The second way is some sort of black swan event. A black swan event would be something like a Rona type situation, something just crazy that no one really saw coming. It's like, what? This is going on? Like, we're dealing with this at this point in time. So something like that could cause that. Obviously, in 2022, we had several different black swan events. Inflation was just one of those. Russia-Ukraine was another one of those scenarios that was kind of a black swan event that most people were like, what? This is going on? This is actually happening? Like, yes. Third way is a major spike in inflation. If inflation spiked up huge again in 2024, which doesn't look super realistic, at least for the first 6 months of 2024, back half of 2024, you could debate, but that's just a throwing darts at a dartboard type situation. But in terms of the first 6 months, we're not going to have a major spike of inflation. So if we did have any sort of major spike in inflation, it would be in the back half of the year. And if we did have that, let's be very clear, the VIX would spike huge. Everybody would start talking about the Fed's going to have to keep raising rates if the economy got too hot or something like that, and it would be a fearful situation where it's like, oh, inflation's not done. The Fed's not done. So right now the belief is the Fed's done, but if you saw, inflation spike back up in the back half of 2024, believe me, people would get very fearful very fast and the VIX would spike huge. Outside of those three scenarios, it's not very realistic for the VIX to spike in 2024 overall. Now, something I love to look at other than the VIX is a put-to-call ratio. So the put-to-call ratio is actually still relatively high. Folks, I love this. I love this. Why do I love this? This shows me that people are not, let's just call it, people are still concerned about the market. If we talk about a put-to-call ratio at 0.6, 0.7, 0.5, then that means people are just very bullish on the market. They're not very concerned about downside risk or anything like that. The fact that even recently we've still been at pretty high put-to-call ratios in the past few weeks, I like that. I like that. That makes me feel very comfortable. If you look at this kind of time period, 2000, let's call it about 2010-ish, through about 2019, many months, weeks, and years during that time period, the put-to-call ratio is actually relatively high. It spiked over 1, which if you go over 1, that's seen as a very high ratio because almost always people should be buying more calls than puts. Like, the market goes up most years, right? So if you look back at this kind of decade time here, right? So let's call it 2010 through, before Rona in 2020. I mean, so there are certainly some time periods where we had low put-to-call ratio, but most of the time, I mean, it was actually very elevated for much of that time, and I loved it, right? Because that was great years for the stock market. People were concerned about double-dip recessions at certain points, or what could happen in China, or this or that. There was always a million different reasons to be kind of fearful, so I love that. The thing that scared me is kind of like what happened before the 2022 crash, right? Which was a scenario where the put-to-call ratio was on the floor. Like almost no one was expecting any sort of downside scenario. I mean, put-to-call ratio was around 0.5, 0.6 for much of that time period in 2021, right prior to the big crash that was coming in 2022, right? If we look back at the great financial crisis, or prior to the great financial crisis, let me put it like that. In 2007, you saw a put-to-call ratio, a lot of that time period, 0.5, 0.6, 0.7. At that particular time in 2007, right before the big crash in 08. So I like being up here. I wouldn't mind to continue to be in the kind of the 0.8 to 1 range for put-to-call ratio. That just means people are still unsure. They're unsure about themselves. They're unsure about the market. They're unsure about their stocks. They're unsure about the portfolio, the economy. Elections are unsure about all that. And I think that breeds a more healthy market overall when you have more people that are concerned. Once everybody's bullish, that's when it starts to get a little scary. If everybody's bullish, that's when you got to be a little concerned, okay? If we take a peek here, this is very interesting. This is put-to-call ratio over the past 5 years, but really what I want you to look at is 2022 in the back half of 2022, because this is interesting. We saw, obviously this should have been the range people were buying put options. Like, you could buy puts for so cheap in 2021 prior to the crash, right? That was actually the time to be loading up on puts. And no one was freaking buying puts during that time, right? Then obviously the crash starts in 2022, and as the crash gets worse and worse, people start loading up on more and more put options. Now, the fascinating thing is, right here you had the 2022 all-time high, and actually a multi-year all-time high in terms of amount of people buying put options versus call options. Now, keep in mind, this was in late summer 2022. The majority of the 2022 crash had already happened. It had already happened at that point in time. And yet people were loading up on put options. And then we saw another massive spike up here to right around 1. And this was late November of 2022. Well, keep in mind, all the tech stocks in the mega cap stocks already bottomed. All those stocks had already bottomed back in, either early November, October, or some of them in September. They had all bottomed. The bottom was already in. And yet people were loading up on put options at that particular moment, right? Even recently, some people were loading up on some put options here, right? So that's very intriguing. Now, I want to talk about a big subject here that I think is very important. It's credit card debt. You hear this, everybody talks about this, and fear mongers, oh my gosh, credit card debt is so out of control. We're higher than we were prior to the great financial crisis. Oh no, it's the end of the world. Hold your horses for just one flip and flapjack in second, okay? Here's the deal. If we go back to prior to the great financial crisis, credit card debt was over $800 billion. Over $800 billion prior to the great financial crisis, right? Today we're a little over $1 trillion. A little over $1 trillion, like barely over $1 trillion, right? Now, think about the state of the economy, or think about where people were in 2007. Think about average net worths. Think about average salaries. Think about the GDP, right? I mean, those were all jokes compared to today in 2023. Here's the United States average hourly wages. And look at where we were prior to the great financial crisis. I mean, we were like $15, $16 average wages prior to the great financial crisis, maybe $17, right? Now we're approaching close to $30 United States average hourly wages at this point in time, right? So we're talking about easily 70% plus higher in average hourly wages than we were prior to the great financial crisis, right? If we look at gross domestic, and remember, credit card debt's only, let's call it 15%-ish higher, 15 to 20%, we can call it 15 to 20% higher than we were prior to the great financial crisis, right? If we look at GDP, right? GDP prior to the great financial crisis is somewhere in maybe the $14 billion type range, somewhere around there, right? Versus GDP nowadays is much higher. I mean, we'll see where the numbers shake out in 2023, but we're pushing high 20s, something like that, as far as GDP in the United States, right? If we look at household net worth prior to the great financial crisis, we can call it was around 60 trillion, something like that, versus 145 trillion plus, easily plus, right? Now at this point in time. So when I look at the credit card debt levels, I say, put me to sleep, Santa Claus? Like, what are we talking about here? We're hardly higher. If we look at even prior to the Rona crash, like, we're not even that much higher than prior to the Rona crash. And keep in mind, once again, everything's gone up considerably since that particular time period, right? It's just because people look at what it was, in the Rona crash when no one was spending, and they're like, well, it's climbed back. It's irrelevant. It's completely irrelevant. I'll put it to you like this. I kind of drew out the lines. This isn't a perfect world. This is how credit card debt should work in a perfect world. The numbers should go up like this over time. Every year, we should see an uptick in credit card debt. It should be a nice, even flow. We don't live in a perfect world, so nothing works like that. But that's how it should be, right? If we go back to prior to the Rona crash, we're right where we should be. It should be a chart that looks something like this. Instead, it looks all messed up because, the government decided to close the economy for a year, and some governments closed it for a lot longer than that, right? And so we have this massive downdraft there and then a massive updraft. But we're right where we should be. Like, if Rona never happened, right, this is right where credit card debt should be, right where we're at. Or maybe you can make an argument that it should be a little higher than where we're at right now, right? This is in a perfect world, but we don't live in a perfect world, so you have these big fluctuations. The fluctuations are irrelevant. All that matters is look back at past history. Right now we need to be pushing like $1.5 trillion in credit card debt right now to be like at scary levels. If we were 1.5 trillion to 2 trillion credit card debt, I would feel very differently about that. Because I look out there and say, okay, most of these other categories, in terms of net worth, in terms of wages, salaries, all those sorts of things, are up, 70 to 100% versus prior to the great financial crisis. So credit card debt would need to be 70% to 100% higher to really make you worried. And that would be kind of in the 1.5 trillion or over category. And that would concern me. A little over $1 trillion, we're actually low. We're actually low for these numbers right now, okay? Now, that could change over the next few years. And then we got a whole different situation to deal with, right? TLT, a lot of people are still wondering, is it time to make a move on TLT? Am I bullish on TLT? And my thought is, don't count me in yet, okay? Don't count me in yet. I'm not convinced the Fed's cutting rates in 2024. I'm not. I think there's a potential they do. I'm not convinced, guys. I am not convinced the Federal Reserve is going to cut rates in 2024. It's a potential, but I'm not convinced. When I look out there, and we're going to go through some of the Black Friday spending so far, some of this holiday shopping, when I look out there, when I look at these company earnings that have been coming in, and some of these new growth rates some of these companies are putting up, the Shopifys, the Metas, and some of those companies, the Amazons, I'm like, I'm not so convinced the Fed's lowering rates in 2024. I think there's a high probability they keep rates the same, but I'm not convinced they're cutting rates. And that leaves open the door to TLT not doing anything for the next year, right? If the Fed's not lowering rates. Also, on top of that, if the Fed's not lowering rates, but then we get some sort of inflation spike, well, then that leaves the door open for the Fed to raise rates, either at the end of 2024 or 2025, if that was to happen. Let's say the economy stays hot. These are things that have to be considered. And so, I think a lot of people are thinking TLT is a slam dunk. And I just looked at it and I'm like, I don't know if it's such a slam dunk. Not yet. Not yet. There might be a moment when it's a clear-cut slam dunk, but when I'm not even confident the Fed's cutting next year, I can't say it's a slam dunk yet. I can't say it's a slam dunk yet. So don't count me in TLT just yet. Speaking about hot and heating up economy. Okay, now we're talking. Shopify stock climbs on Black Friday sales record. Shopify e-commerce climbed. It's a stock of mine. I'm a very happy shareholder. Notched a new record. Merchants that use the platform recorded $4.1 billion in sales on Friday after the Thanksgiving holiday, a 22% increase from the year ago period. I mean, that was a way bigger than anybody was anticipating. No one was expecting 22% rise for Shopify in regards to that Black Friday. I mean, from what I saw, a lot of estimates were kind of at like mid double digits, something like that. So meaning like, we can call it teenish percentage, maybe 15%, something like that. So the fact that they came in with a 22% number, I heard one guy was predicting kind of 17%. He seemed like more of a bullish guy. So the fact that they came in at 22% is very good news, not just for Shopify, but likely the holiday season as well. Shopify has this really cool thing going on. It's like Black Friday, Cyber Monday, and it kind of shows you sales per minute. And it constantly updates. It was really fascinating. I kind of watched the thing for just a couple minutes, and the sales are fluctuating. Basically, Shopify, as I was looking at this, they were doing about $1.8 million in sales per minute. $1.8 million in sales per minute Shopify was doing. Unique shoppers were over 60 million. Around 14,000 orders are being placed every single minute right now. Shopify has. So that was just a really fascinating thing. If you guys haven't gotten to check that out, definitely check that out. I thought that was pretty dang cool. Now, in regards to Shopify stock, I regret not owning more of the stock. It's the 9th biggest position in the Patreon portfolio, and I just regret it. Shopify is such a perfect stock. It's such a perfect stock. And the reason it's such a perfect stock is they have so many growth levers from everywhere. They're always innovating. Like when I think about Shopify, I think about growth levers everywhere. They always are attracting more customers. They're always, well, I don't say they're always going up in price, but they can always go up in price whenever they want, basically, because what they deliver in terms of value is so low compared to what they charge. So if they want to go up on price every year, every other year, every 3 years, something like that, they got that in the bag. And people aren't switching from Shopify that use Shopify. So they have that growth lever. They have payments, which is something that's ballooning for the company overall, right? They obviously have their in-store shopping that's expanding rapidly for them. I believe they around 30x'd their in-store sales versus kind of where the foot traffic was at from what I saw in retail. So when you go through all these different categories, I mean, they just have growth levers all over that company. They obviously have the back end to help out your business. I mean, there's just revenue opportunities for days in regards to Shopify. And I love business models where there's so many different growth levers everywhere. Amazon's one of those companies. Intuit's been one of those companies over time. Adobe's been one of those companies over time. Apple's been one of those companies over time, right? Meta's one of those companies. I love companies that have several different growth levers all over the company. And it's just beautiful. So 9th biggest position in my Patreon portfolio. I wish it was a top 5 position in my Patreon portfolio, just to be quite honest. By the way, everybody that got the $62 Holy Smoke is this ain't no jokers deal, congrats to you guys. Hope you guys are enjoying the course. I've received a lot of DMs and messages that you guys are loving it. So glad you guys are enjoying that, learning lots. That tier is back to $125. It's normal price now at this point in time, and we got obviously the $19 tier, which does not come with the Becoming Master of Stock Market course. But glad you guys are enjoying that, and glad you're able to take advantage of that. I saw this. Some guy on Twitter posted this. Some Holy Smokers guy. So this is fascinating. You want to know what the stock market is likely to do in the month of December? Based upon seasonal trends, the stock market is likely to go up quite significantly in December. This does not mean it's guaranteed. But based upon kind of historical trends, so what this let's call it, dotted line here is, that's average S&P 500 path since 1950. Okay, and obviously this is a 2023 S&P 500 path so far, and so if it's anything like the average has been since 1950, we should see another big actually run in stocks into December, which would kind of fall into the Dan Ives, the Tom Lee bull cases, because a lot of them have been calling for a hot December, okay? A very hot December. And so, not in terms of weather, but in terms of stock market, if that happens, man, holy smokes, this ain't no dang jokers. Now, if that does transpire, here's what I think is going to happen in the first quarter of 2024 in the stock market. What I think is going to happen is I think if we have a hot December and big tech continues to run, mega cap continues to run, I think in Q1, we will see some money exit out of a lot of the mega cap and the tech stocks, okay? And I think we'll see a rotation of that money into some of the small caps and mid caps. I think that's what's likely to transpire there. And I think that could cause the indexes to go down in the short term. I think cause some fear to creep back in the market, which I think would be healthy overall, right? And so that is definitely something I could see playing out there. I think Wall Street, it seems to me, in kind of seeing some of these small caps, it seems like Wall Street's ready to start to position into some of these guys. And I think they're starting to become a little more convinced of soft landing. And so, in that the economy is going to be just fine in 2024. And so, if the economy is just fine in 2024, then it seems to me like people are going to want to position to the smalls and mids in the first quarter of the year, because there could be some extraordinary gains as kind of the year ticks on, and you have an economy that's strengthening rather than weakening, right? Now, there's only one of two scenarios that's going to play out in 2024. One is the small caps are going to roll. It's going to be a great year for small caps. And the other is the market dies. There's no other scenario that plays out. Small caps been in a bad place in 2022. They've been in a bad place for almost all of 2023 until very recently. So, you can keep smalls down for 2 years. You're not keeping them down for 3 years unless you have a crash. So unless the market dies in 2024, small caps are going to roll. One of those two scenarios is playing out, okay? I would say there's a higher probability that smalls are going to roll in 2024, and it's going to be a great year for them. I think there's a higher probability. I do not think it's guaranteed or anything like that, but I do think it's a higher probability than the market dies in 2024 overall, okay? Wall Street's got to make money, and that's where you can make money. If you don't have any black swan event in 2024, and the economy is actually strengthening, the consumer is strengthening, business confidence is strengthening, which is very much a possibility, you're not going to make money in shorts. And you're gonna be looking out there and you're gonna say, damn, where can I make some money? It'll be the smalls and mids at that point in time, okay? Now, I want to talk about something here, because I know this happens to other people as well. You own a stock and it becomes such a big weight of your portfolio that it kind of becomes a blessing and a curse. And this happened actually today in regards to Meta. Meta in the public count is now roughly 35% of the portfolio, which is a heavy, heavy weight. Much heavier weight than I would really want it to be quite honest. And I haven't even been buying Meta really since last year. But yet the weight has just become bigger and bigger and bigger and bigger. And it's becoming gargantuan. And the reason being is the stock's gone up so dang much. We're up $386,000 on the stock. And it becomes a blessing and a curse, because now this one stock starts to dictate the entire portfolio. A good example of this is today what happened. I mean, I was shocked when I actually saw that public count was negative today, $1,700, because I looked and there were so many of my stocks were green today. If I recall, Amazon was green, that's the third biggest stock. Tesla was green, that was my second biggest stock. Elf was green, that's one of my biggest stocks. I looked out there and there was a ton of green stocks, but yet the portfolio was red, and it's because of Meta, right? And so you kind of get into a tough situation of like, do you sell some of that stock to put that money in other stocks so that stock's not a big weight? And it's really tough decisions. And I was considering a lot of this, actually, even on my Twitch live stream here today. I'm like, man, should I start selling some of these shares and put that in something else? But you got to look at it on an individual stock basis, because the bottom line is in regards to Meta, the stock's still undervalued, right? They're probably smashing estimates right now, literally as we speak. If Shopify is putting up those sorts of numbers, and we're seeing these sorts of Black Friday, Cyber Monday numbers that are likely coming out here, that likely means Meta's quarter is going to be way better than people anticipated, because the biggest beneficiary of things being better than expected is Meta. They're the biggest beneficiary. And so I look out there to Meta and I say, the stock's trading cheap, and they're likely going to blow away all these EPS estimates these analysts have. And so how could I sell a stock like that? Just because it's a big weight in the portfolio? It's not like I put that much in it. It's just it's gone up so damn much, right? So this is what I look at in Meta, and I'm like, I don't know. I can't make that move. I can't make that move, really, right? And then I don't know how much you guys, look at Llama 2. But Llama 2 is out now, right? The next generation of our open source large language model. I'm hearing more and more excitement, hype about this product, what it means for Meta long term, and Meta being considered as one of the sneakiest AI plays, potentially in the entire stock market, to be quite honest. I mean, they go through all this different stuff, and, this is not my level of expertise, okay? I am no AI expert. But, Meta goes through why Llama 2 is the bomb, okay, and why it's better than everything else. I call it the bomb. And, really fascinating as far as what they got going on there. I'm hearing more and more hype about it. I don't know what it means for Meta in terms of numbers over the coming years. Open source, and they're supposed to make money some different ways. I still don't understand exactly how they're going to monetize it. I don't even think Meta understands how they're going to monetize it right now. The industry is so new right now that I think everybody's kind of in that awkward stage of figuring out how do we monetize this? How are we going to make money off this, right? And this happens when you're in a new industry. Guess what? Meta went through this before. Everybody didn't know how Meta was going to make money. No, I'm being dead serious. When Meta went public, no one understood how this company is going to make money. I'm talking about the overall company. They're like, wait, how are they going to make money? So they have a bunch of people using this Facebook platform, but how are they going to make money from that? Like, people didn't get it, right? And now in 2023, we all look back and we're like, ads. Of course, we know how they're going to make money. But back then it was not clear cut. Same exact things actually happening now in the AI space. I've seen it with Palantir. People want to know how they're going to make money from AIP. People are, even Karp and the team was kind of like, I don't know, we're going to figure it out. We'll make money from it. We'll figure it out. Meta's, I think, in that awkward stage right now, trying to figure out how they're going to monetize this thing. But the bottom line is, if you have new big platforms, you're going to be able to monetize. You're going to be able to make bank off that over time, right? I kind of Googled around a few different things, and I, wanted to see kind of this Llama versus ChatGPT, which one's better. And I found this use case. Consider the primary use cases for digital marketing efforts. If you need a tool primarily for customer service chatbots and quick interactions, Llama might be suitable for you. Now, on the other hand, if you need your needs are broader, such as content generation, creative writing, or support with coding, ChatGPT might be best. And that's what we're going to find out over this next couple years is there's going to be certain AI players that are better in certain verticals versus others, and others are going to have weakness in certain spots, and others are going to pick it up. And so, we don't even know how big that is for Meta. This could be a multi-$100 billion opportunity. We don't know. Could be $1 trillion. We don't have no clue right now. I have it baked in for zero numbers. So anything this Llama produces over the coming years, anything they really make happen there, that's all gravy, man. That's all cherries on top. When it comes to AI, Meta's going to make bank off this in two direct ways, okay? So one is, the better and better the AI is and the algorithm is for Meta overall, the more relevant posts it shows you, which obviously keeps retention higher. The longer people use Meta or are willing to share stuff with friends and family, guess what? The more likely you're going to see more and more ads on Meta and they're going to be able to obviously monetize on that, right? So that's one direct way AI helps them. The second way is better ad targeting. You get, the businesses get a better return on investment of that, right? The better the return on investment businesses get, the more they want to spend more money, right? If you can tell an advertiser for every $3 you're going to spend with us, for every $3 you're going to spend with us, we're going to be able to get you $10 back from that. Well, guess what? The advertiser wants to spend a whole lot more, $3 and $3 and $3, because they're like, dang, man, I could just make more and more money, right? So I think that's the second big component, is basically better ad targeting, better ads in general, better creative, and I think Meta's going to be able to make a lot off that as well. So AI is going to be a huge boost to Meta. It probably already is starting, but I think you'll see that play out really more so over the next few years, okay? Now, over the next 3 days, we got a lot of earnings coming. Tomorrow after the bell, CrowdStrike, Workday, Intuit, Splunk all report, and those are all pretty big market caps. Then Wednesday, we got Foot Locker and Dollar Tree reporting. I just ordered some stuff on Foot Locker. They got some good Cyber Monday deals going on out there today. Snowflake and Salesforce, two big dogs, reporting Wednesday after the bell. I will be live streaming all these earnings on Twitch over the next 3 days. So if you haven't followed me on Twitch, make sure you follow me. That might be linked in the description down there. You can just search Jeremy Makes Money on Twitch. You'll find me. Kroger reports before the bell on Thursday. That's an important one to really figure out what's going on with inflation. And then after the bell, Ulta's reporting, which that one will likely move ELF shares. It could even move Honest shares a little bit. We'll see. that could move retail in general. So alt is going to be very important, folks. Okay. Appreciate you joining me as always. Thanks so much for being here. Thank you for being subscribed. If you're looking to apply, join my private group, get access to all my best courses, access to 6 and 7 figure Discord chats, access to exclusive videos from me, access to see the stocks I'm buying and selling, my nearly $2 million Fidelity account, and the ability to join the 6 and 7 figure club, all that good stuff. Then check out the pinned comment down there. You fill out an application, and we can see if we can get you in there either this week or next week. Okay, that's pinned comment. Much love, and have a great day.